Good morning and welcome this morning to Trading Futures and with a great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. There's the opening bell. That means it's time to get up and running here this morning. I am joined out there in the chat by my good friend Connie Hill, and she's a 20-plus year veteran of the financial markets. She's there to help answer your questions along the way, so I'm glad to have her with me today. It's an interesting market yesterday and today for sure. We're going to talk a little bit about what's going on. We've got some energy futures in the mix. We've got equity futures that are moving, and we've got kind of an unrelated but very related event going on that maybe leads us to the premise of why an investor might use futures as a means to hedge against specific discrete event risk. And we'll talk about that as we get into this discussion today. I'm going to do this really quickly. I'm going to go ahead and pop into my housekeeping items, and we're going to go over to the Thinkorswim desktop software platform. But we're glad to have you here with us, whether this is your first time or your 100th time. I'm glad to have you in this discussion with me this morning. We're going to have a lot of fun, hopefully, along the way. Might be a wild ride, so properly warned you be, says I. So let's take a look really quickly here. Remember that everything that we talk about is simply for illustrative and educational purposes only. It is not a recommendation of any particular security or strategy or account type. Remember that futures and futures options trading involves substantial risk. It's not suitable for all investors. Make sure that you are aware of those risks. Read the risk disclosure statement for futures and options prior to considering any futures transaction or strategy. Remember that futures trading requires separate trading authorization. I'm going to show you where you might start that process if you are interested in trading futures and you don't know where to start. So be aware of the fact that futures trading requires a futures margin to initiate and to maintain a futures position. Sometimes that can be substantial. It is a function of the notional value of the futures contract. It is also a function of volatility and risk. It can and does change those amounts of those initial and maintenance margins. So we'll talk a little bit about that as we get into this discussion. A couple of other things that I want to mention. Remember that we're going to be using the Thinkorswim desktop software platform, specifically the paper money version of the platform. Not a guarantee future success out there in the real world. However, it's a great learning environment. It does not, however, do certain things that a live trading account would do, and it performs differently than a live trading account, namely in the function of order fills. Oftentimes, the paper money account is going to fill at the midpoint between the bid and the ask, whereas a live trading account may not always do that. A couple of other things really quickly that I want to talk about since we're going to discuss them in this discussion today. Virtual currency derivatives involves unique and significant risk. Make sure that you read and understand the NFA investor advisory and the CFTC customer advisory on those products. Remember that those virtual currencies are digital representations of value. They do not have legal tender status, and therefore they have some specific and unique risks. We're going to use technical analysis in this discussion. It's not the only way to look at the market. It is theoretical in nature, just like fundamental analysis. It is not a guarantee of future success out there in the real world. Also, let's talk specifically about using stop orders when it comes to futures products. When you create a stop order that executes a market order, that market order gets replaced or substituted by the exchange for an exchange designated limit order within a protection range. So it becomes as if it were a limit order to begin with. That order could also be rejected, and there is the possibility that that order does not fill. That works the same way for a buy stop order, a sell stop order. Any stop order that triggers a market order is subject to this potential. So volatility or no, that is a concern and that is a consideration. So just be aware of that fact. We'll talk a little bit more about it as we put some of those specific trades on. So we're going to pop over here to the Thinkorswim desktop software platform. We'll take a look at what's going on here really quickly. I'm going to pop over here to the charts, and I want to pop into our futures grid really quickly, just to kind of see what these equity futures are doing this morning. It's been an interesting couple of days. Not only we have the aftermath of the Supreme Court decision last week impacting tariffs, which impacts a lot of things. But we have geopolitical risk. We have specific event risk in that you had certain, if we think about where the leadership has been in the market, it's been largely in technology. You have an impact coming from a couple of elements of the technology space yesterday that are somewhat, if you think about where that leadership has been, somewhat concerning. So this leads me to the discussion of hedging. So let's talk through these for just a second, and then we'll jump up into a couple of trade examples here, illustrative examples. So this is /ES. This is the S&P 500 E-mini futures. And we can see that at the moment, continuing some of that downward movement. I'll just zoom in here. We can see some of that downward movement continuing from yesterday. There was a little bit of a rally up off of the bottom yesterday late. And there was a little bit of a push higher here as the futures contracts started to get moving this morning, as they were kind of rotating back into the driver's seat. Now seeing a push to the downside, down 0.3% on the day so far. RSI continuing to stick a little bit lower here. So there is definitely still a bit more bearishness here in the S&P 500 E-mini futures. The NASDAQ, on the other hand, maybe not quite as bearish. We saw a little bit more of an upside push, although it's kind of sinking off of that down 0.15% this morning. RSI relatively flat. That would suggest perhaps a resurgence or a reversal, kind of a shift back into some of those NASDAQ names, but that also presents the possibility because of where some of these, not necessarily existential threats by any means, but certainly some threats to some of the leadership within this particular index exist. And then we'll take a look at the small caps. And the small caps, again, sitting down on their 50-period moving average in this particular case. Pretty big downward move yesterday in the futures for the Russell 2000 yesterday. A lot of that has to do with the fact that the Russell 2000 index itself has a fairly substantial bias towards technology, much like the NASDAQ. In fact, about 23%. That will get rebalanced in June. We'll see how those percentages change for the index. But this is also giving us kind of a flat doji candle here this morning. So there is maybe the potential, as we take a look at the RSI kind of kicking back in the upward direction, of some up off of the bottom rally here in the Russell 2000. I'm going to zoom back out, and I'm going to use this grid just to kind of talk through a couple of other areas really quickly. So let's go to /VX. Now, this is a very common way to use futures contracts as a measure of market movement. I know we talk about them in the title of this particular webcast is trading futures, but it's also a way that traders, even if you're not trading the products, can get kind of getting into the function of understanding what's going on in elements of the market, building, in fact, if you were a dashboard. So the VIX futures, which is interesting, VIX futures down just a little bit on the day, down 0.46, almost 0.7, kind of almost a full percent as these start to move to the downside today. So given back a little bit on the VIX futures off of some of these highs. And that becomes kind of an interesting perspective in that the market facing some of those challenges, the VIX futures down, the index is down, and yet VIX is down as well. At least the VIX futures are down at the moment. We'll see if it stays that way. Let's take a look at a couple of other areas. /CL. This is crude oil. Crude oil was up a little bit more this morning, coming back off a little bit, but holding this support level right around the 66 level. We'll call that level of support. Yeah, Helen, the VIX was up a little bit. Oil was up a little bit more this morning. kind of settling back a little bit here. And as the cash market gets up and running, we'll see how that impacts these areas. /BTC, the Bitcoin futures. And again, we're talking about those cryptocurrencies. Keep those things in mind. Back down on a level of support here, a little bit of a more downward move in the last 2 trading sessions in cryptocurrencies. However, what's interesting, and as we look at this, is a little bit of a bullish divergence going on in Bitcoin futures and cryptocurrency futures. That would then beg the question, what's going on with /GC with gold futures? And gold futures down a little bit. Interestingly, we saw some strong movement in gold back up above this 51.23 level, still staying above that kind of psychological resistance level at the 5,000 mark. Gold futures coming back off a little bit, /SI silver futures coming back off a little bit here this morning. There seems to be almost a little bit of wait and see mode at the moment. And that can sometimes be concerning, that kind of wait and see moment here. So what doesn't give us the opportunity to wait and see is what just popped up in the chat. That is our feedback survey. Do me a favor, don't wait on this feedback survey, but just click on that link, open it up, set it aside so that you can take advantage of being able to help us to make these sessions better. Connie will pin that to the top of the chat so that you can come back and answer that. But do it sooner rather than later so that you don't miss that feedback survey. We certainly want to capture and we read every bit of your commentary. But again, taking a look, here's silver futures. I wanted to also look at a couple of other areas, /HG. This is copper. We'll come back to this. Copper seeing a little bit of strength this morning, /NG. For those of you that are digging out of the blizzard, this is perhaps a bit of a relief as that cold weather seems to be persisting as natural gas continues to move perhaps to the downside a little bit. All right, so now that we've kind of got that perspective going on here, I wanted to talk about a couple of things going on. First of all, let's pop over here into that. Let's put this back to /RTY, but let's pop over here to our futures grid that we've built before, and I'll share this with you as well. This is our futures grid with labels. I'm going to go ahead and share this grid with you so that you've got it. Remember, when we share things, in this case, this grid, it's also in the description for this particular webcast. It is not guaranteed as to time or accuracy. So let's put this on the side-by-side view. We'll just kind of replace and restore our cells here. And I wanted to take a look at /CL, crude oil, for just a second. And we can kind of see what's going on with crude oil. Here is that support level that we had drawn in at the 66 mark. And you can see how crude has kind of come back down to that 66 mark, rallied up off of it, pulled back to about the 66.2, rallied up again, now pulled back. And, given the fact that we've got some geopolitical instability, right? We've got concerns about the instability that's happening in Iran and the Straits of Hormuz, which in previous years in the oil market of the 80s and 90s, had we been positioned and postured the way that we are, I think we would have seen oil well above where it is now. Now we're talking about the fact that, there is still, even if that Iranian oil comes off the market, even if the Straits of Hormuz gets closed down, there are many other ways now that have been opened up around the Straits. Talking about maybe constraining some supply, but we're still in an oversupply situation. However, there is still premium risk. There is still geopolitical risk premium going on in the crude oil market. So what I want to do is I want to go over to the trade tab here really quickly to /CL, to crude oil. And I want to open up, not the option chain, but I want to come down here to the product depth section of crude oil. And I want to go to the futures market. And we've looked at this before, but this is, I'm showing now the current, let me pop this back up. So I'm showing right now the current delivery, which is the April, the active delivery, all the way out to the July, September, October, November, December deliveries. Okay. And what this curve is showing, what this futures curve is showing, is that that price going forward is less. This is kind of a typical backwardation curve where futures contracts for near-term delivery or for recent delivery are priced higher because there is supply constraint or the potential for supply constraint. And those future contracts for delivery further out in time are priced less. So here's where this contract is priced, 63.5 for the December contract. And right now we're seeing this contract, the active contract, the April delivery, sitting at about 66. So about a $3 disparity between those two contracts. The furthest out that we're looking at on this chain and the current that we're looking at on this chain. You can see there's about a $3 disparity there. That would suggest that a trader looking at that possibility would expect two things to happen, and not necessarily mutually exclusive from one another. The first expectation would be that the near-term delivery may go down in price, but if there's still that geopolitical risk, and we've got 24 days of that time frame in this contract for that geopolitical risk to manifest itself, this contract still could go higher. Now, what could also happen is that if that geopolitical risk is then removed, then this price, the further out price, could go lower. And this price, the current delivery price, or that next delivery price, might continue to roll forward and increase. So a trader could trade the disparity or the difference between these two by putting together a calendar spread, meaning buying one expiration and selling another expiration, or selling one expiration and buying another expiration. And then what we're doing in that particular case is trading the difference between those two. So I put together an idea here and looking at this geopolitical risk that might in the near term push those near-term delivery prices higher if we have that geopolitical risk. So I looked at a calendar spread that was the April-July timeframe. And the way that I looked at this was going long the April contract and short the July contract, meaning if that process gets resolved, that geopolitical risk gets resolved, we could see that long-term contract go down in price and benefit from the width of this spread. Right now, what's happening, though, as crude oil sits back down on that level of support, is that the width of this spread is getting narrower, which is not what we want it to do. So I wanted to track this really quickly. So I put this trade on last night, in kind of in the middle of the night. And here's that contract spread. This is the futures calendar spread. So I went long the April contract, and I went short the July contract. And the difference between those two is what I paid for this calendar spread. I paid 88 cents for this calendar spread, or that's what it's trading at. That's not what I paid for it, because remember, I'm not paying for it necessarily. I am creating an initial margin to initiate this position, but that's what it was trading for. You got to remember sometimes to get out of that mindset of this is what I paid for it, this is what I received for it, and put it in the context of a futures contract in terms of that initial margin. So that spread, the difference between these two, was trading at 88 cents when I put this position on. long the April contract, short the July contract. It is now trading at 73 cents, which is not the direction that I want it to go. In fact, that spread is getting narrower. Now we can chart this spread. We can chart this by simply looking at, let's right click this, and let's send this to the charts. Actually, let's do this. Let's go back to our trade tab to this contract right here and right click. And we're going to do more info and we're going to send this to our Thinkorswim chart. All right. This is the difference between those two. And you can see what's gone on. So when I put this trade on in the middle of the night, it was up here at around 88 cents. My expectation was that the width of that spread, the difference between those two, was going to continue to increase. That either the long-term contract was going to go lower, the short-term contract was going to go higher, increasing the width between those spreads, or one or the other was going to happen. Either the short-term contract was going to get more expensive and the longer contract was going to stay where it was, or the short-term contract was going to stay where it was and the long-term contract was going to go down. Yeah, and I agree, Helen. You know, as we get into more of this, as we start to see this geopolitical risk, that could widen out pretty quickly. So I'm not taking this trade-off yet in this particular case. But you can see what's happening is in the short term, that spread, the difference between these two, is narrowing. So it's working against me slightly here in this particular case. Now, what I've done on this particular contract, on this calendar spread, I'm going to go back to the monitor tab, is I've put a closing order on this trade. So I entered the trade when the spread was trading at 88 cents. I've put on an order to close this down. So I'll show you where it is here in my working orders. It's right here, this futures calendar. And my order to close this down is a limit order if this trade, if this spread trades at $1.25 wide or higher. Then take the trade off. It's currently sitting at 74 cents. So I'm looking for this spread to get wider. And I'm willing to take this off at a particular level at $1.25. So that's what I'm looking at in this particular case in terms of this relationship. Now, as we get through, and I'm glad, Carol, you brought up the State of the Union address. That may be a big driver here in this particular case. All right, so that's one trade. So let's look at another trade here. And let's look at, I'm going to go back to those charts for just a second. And I'm going to jump out of the futures market for just a second. I'm going to go to this particular stock. This is IBM. And this is the reason why I wanted to talk about specific risk. So IBM, kind of one of the last bastions of programming languages like COBOL. For those of you who grew up in the 70s and 80s, if you were involved in computers at that time, which my dad was, which I was, you learned how to program in BASIC and you also learned COBOL. I learned a little COBOL. My dad is one of the last few programmers that I know that writes natively in COBOL. His services are widely sought after. And in fact, that's one of the things that he does. Here's what happened yesterday. And I did Fortran as well, Helen. But here's what happened yesterday. Anthropic, which is the parent company, privately traded company, parent company to the Claude AI system. And Jim, see, I knew there were some common folks out here, some COBOL folks. Anthropic announced yesterday in a blog post that Claude AI now can restructure and reprogram in COBOL. That shook IBM significantly because this has built an entire ecosystem. They are now, today, Anthropic is doing a visual demonstration of that. That could shake not only the, yeah, it is for sure. That could shake not only IBM, that could shake the financial markets. Nearly 80% of the programming language used for ATMs, the automatic teller machines, and point of sales machines is done with a COBOL backend. And because of that, because this now represents a threat to that ecosystem that's been created, this represents a threat in the short term. The market will react to this potentially. This represents a threat in the short term to some of those tech names. So that becomes a challenge, especially if you go back to your monitor tab and you see if you've got a group like our beta weighting group that I've got here that's got financials in it. It's got airlines and aircraft manufacturers, airlines that use COBOL on the back end in some of their dispatch processes, General Electric, which grew up at the same time. You've got some energy companies here. You've got Walmart. You've got Microsoft, which, obviously purveyor of BASIC, at least initially, but still has an impact here. The threat is real. But you've also got Amazon and Avgo. So there's a number of names here. So what I want to do is I want to beta weight this portion of our portfolio to /MNQ. Because this is the technology futures contract. /MNQ is the micro or the mini contract for that E-mini. So this is the smaller contract. And what I'm doing by taking all of these disparate, if I take the beta weighting off, all of these have their own individual deltas based on the number of shares that are contained in this position. If I beta weight this, I'm now putting these into a common coefficient. So the exposure that this portfolio has, the exposure of this portfolio to the MNQ, to a technology, to the technology sector, if you will, is 25 deltas. We've got a specific event risk, this announcement by and virtual demonstration by Anthropic today. Now, we've said it before, hedging is not something we do all the time. As an investor and as a trader, we hedge based on specific event risk times because hedging can be a draw. So as we get into this discussion, we're going to use /MNQ as a hedging instrument here to offset over a short period of time the impact to the potential impact to the stocks that we've got in this particular segment. Now, this may be your particular portfolio or a trader's particular portfolio might have more or less exposure, and it might have more or less exposure to a particular product. We're going to use this as an example, and I'm going to talk through this process. So we've got about 25 net deltas, net MNQ deltas. So let's talk about how we might expose ourselves or remove some of that exposure. So we're going to go back to the trade tab here. So thank you for following along with me here as we get into this discussion. Actually, I'm going to go back to the charts tab, and we're going to go to /MNQ. For those of you that are brand new to futures, I know we're getting a little bit deep here. I'm gonna ask Connie to do something for me here. I'm going to ask Connie to put the playlist link for this futures webcast in the chat so that those of you that are brand new or that are just getting into this and your heads are spinning now have a place to go to, establish some understanding of what we're doing here with this futures class. So Connie, if you do that for me, I would appreciate that. So here's /MNQ. And we can see that it saw a little bit of a rally here on the right-hand side. It's starting to pull back just a little bit. So now what I want to look at in this particular case is on this left-hand side. This is the short-term view. This is the today 5-minute. This is the 1-year daily on the left-hand side. I'm going to open this up so that we're looking at this. So we're looking at this group right here. And this label. And by the way, this label is in my futures grid, so you can apply this if you want to. But the tick size is 0.25, which means that this is our significant set of digits right here. And that's going to move in 0.25 increments. You see how it's moving from 0.25 to 0.75 to 0.5 to 0.0. So it's going to move in those 0.25 increments. The tick value in this particular case, every time that ticks, that's 50 cents. Every time this point moves, the one just to the left of the decimal, that's $2. So $2 times this index price gives us our notional value. So this $2 becomes our delta, essentially our delta coefficient for one contract of the MNQ. So if we were to go short one contract of the MNQ, we are removing two deltas out of the portfolio, if that makes sense. So if we wanted to remove all of our risk out of that portfolio, we could even go to the /NQ, which is the larger contract, and we're going to remove 20 deltas. Now, there's a difference here, and this is how we kind of get to this discussion, right? So I'm going to look at our futures dropdown. Here's the /NQ. Look at the initial margin here for establishing a trade in the /NQ. So /NQ, that initial margin to go short that contract is $38,520 because of that notional value. Okay. If we look at /MNQ, let's come back up here. /MNQ, our initial margin is $4,000 or $38.52 on the short side. Okay. So what we can do is take some of that exposure out. If we were to use the /NQ, the big contract, we were very likely over hedging a little bit because to Helen's point, there is the possibility that the market shakes this off, it figures it out, and it rallies. So we don't want to be caught over hedged. But if we can use this /NQ or MNQ, and we were to initiate, let's say, 3 contracts of this /MNQ to reduce that exposure to under 20%, right? Or under 20 deltas, if you will. So how am I getting this, Alex? I click on the drop down and I select futures. And I can do that from the charts tab or the trade tab. Anywhere that I've got that symbol drop down, if I click on that drop down and I go to futures, now I'm seeing this information here. So what we're going to look at doing here in this particular case is, and again, remember, a hedge is not designed to make money. A hedge is designed to protect against adverse movement. So we're going to go back to our /MNQ, and we're going to look at initiating a position here. So I'm going to do this with one single contract, and I'll show you the impact of that single contract to the movement of, or that delta exposure in our portfolio. Carol, here's the relationship, and here's the impact. Claude AI now can, according to Anthropic, can program in COBOL, can write code in COBOL. IBM is the current last bastion of programming in COBOL, which runs a broad depth of financial systems. All Anthropic did yesterday was release a blog post that said that the Claude program, the Claude AI program, can code in COBOL. That took 13% off of IBM's stock price to the tune of $3 billion. That's why it has an impact to the market. That's why it has an impact to the market. It's a disruptor. Is it real? It doesn't matter. The market took it as that. So we're protecting against specific event risk in their virtual or their visual demonstration of this today. So what we're going to do in this particular case, and financials, not just tech, but here's what we're going to do, is we're going to go short one contract of the /MNQ. Now, here's what I do. I've got a 2-place grid, and if I click on restore cells, then I've got those two side by side. If I click on maximize cell, then I can look at one versus the other, and I can bounce back and forth between the two. So here's the short-term chart. This is today's 5-minute chart. So what I'm going to do is I'm going to look at putting on a short position here. And I'm going to right-click here on the chart, and I'm going to sell a single contract, okay? And I'm going to sell this single contract of the /MNQ. We're going to look at getting short this contract. And what I'm going to do is I'm going to do this as I want to get into this really quickly just so that we can see the demonstration. So what I'm going to do, not trade a limit contract, but I'm going to come up here to where it's currently trading in this range, and I'm going to sell it up here. We're going to create a sell order. And we're going to sell that at a limit price, 24881. Now, here's our transaction cost. Here's our initial margin. And I'm going to put this in my beta weighting group. So we're going to go ahead and we're going to sell this just so they can demonstrate this. And we sold that contract. Now we are short this contract. So if I go back over here to my monitor tab and we look at that /MNQ, which has a -2 deltas because we sold it. Remember, our coefficient was that. We'll go back to that chart for just a sec. Our coefficient is this number right here, that point value. That tells us the number of deltas that that's going to add to or take away from that beta weighting. We go back to our monitor tab. We've just taken out 2 deltas. We've reduced our exposure from about 25 deltas to about 23 deltas. That offsets that possibility that that downside movement disrupts this particular portion of our portfolio. It's hedging against that adverse risk. Now, we didn't have to pay for that hedge. We had to establish an initial margin. So we're tying up capital, but we're not paying for it necessarily in that sense. We have to tie up the capital, but remember, our goal here is not to make money on this. Our goal is to offset the potential adverse movement. That is what is the important component here. And if we wanted to offset more, we could go short another contract or another 2 contracts. Each one of those contracts is going to take 2 deltas out of this relationship. So we can fine-tune and adjust our amount of exposure in this particular case. All right. Wow. All right. So that's kind of an interesting relationship here. Let's go back over to the trade tab real quick because I wanted to do this, and I'll talk about this for just a second. Here's the /MNQ. So let's talk to John's question about interpreting that forward chain. So I'm looking at the same kind of curve here. Here's the active contract. That's the March contract right here. And here are the forward dated contracts. Forward dated contracts being these later expirations or later deliverables. This goes all the way out to the March 27 deliverable. And you can see that this contract is priced down here at 28,880. And this contract here is priced at 25,553. What that means is this is what's referred to as a contango curve, a contangoed curve. Okay. This has an expectation that out in the future, there is going to be greater risk. Those contracts, potentially, those longer dated contracts, because there is greater potential risk, are currently trading at more. There's an expectation, on the other hand, though, that as we get towards those contracts, this is going to drift down or resolve itself lower. So oftentimes a trader trying to trade this contangoed curve, meaning short term is priced lower than the long term, may look at selling that long term and buying the short term, or if they think that that contango is going to steepen, buying the short term and selling the long term and expecting that that's going to go down. So there's a lot of different ways. We've traded a couple, or talked about this in a couple of different webcasts. That's why I asked Connie to put that playlist out there. Okay, so let's do this really quickly. How did I make the decision to trade NASDAQ or the NASDAQ futures versus the financials, since that software will impact mainly financials? Well, here's the thing. I know that the impact is likely going to happen in the technology sector and not necessarily in the financial sector specifically. Plus, I know that there's a fair amount of liquidity in these /MNQ contracts. That gives me a more direct hedge. Now, I could use other products. We could hedge this with VIX futures. We could hedge this with the big MNQ contract. We could hedge it with /ES or /MES, which would give us a different relationship. But that's one of the reasons why we might use /MNQ versus something else. It's the most closely related to where the exposure is in this particular portfolio. Now, you could, Momo, you could use put options. Remember that trading options requires, it has its own risks. It is a leveraged product, just like futures. Make sure you understand the characteristics and risks of standardized options before considering any options transaction. Put options are going to be an upfront cost, and they have time decay. This futures contract does not have time decay. So that may be one reason why traders may use a futures contract versus an options contract to provide a hedging mechanism. But it's a big hammer in this particular case. It's not as big as the /NQ, but it is still a pretty big hammer when it comes to delta reduction. All right. So I wanted to do this really quickly. I know we're running out of time here. Time always goes very quickly, but I wanted to pop you over here and talk about this because I know we've got a number of folks that are here for the first time. What I wanted to do is this: take you to schwab.com/futures. And if you go to /futures, schwab.com/futures, this is what you're going to get is this overview page of trading futures at Charles Schwab. If you're interested in how you might get started, or why, or how, click right here where it says get started. And this is going to give you the steps to open up a futures trading account, to open up a brokerage account. I'm not saying that, this is the only place that you can trade futures, but this is some place that you can go to start that process. So this is a getting started location. So go to schwab.com/futures/trade futures, or click on that getting started button right there. And we get into that discussion. Now, let's pop over here really quick. If you go to the youtube.com page and you type in the words Trader Talks Webcasts, or you go to youtube.com/@Trader Talks Webcasts, and I will post this link. And again, remember, whenever we post links, those are not guaranteed. Those are not guaranteed as to time or accuracy, but that's how you find this page right here. What we ask you to do is click on subscribe, but then you can type in here trading futures. And now you've got a bunch of webcasts in here talking about trading futures. So some good stuff here. And I'll tell you what, if you do this futures, let's do this futures stops. Stop orders and protection points on futures. Go back to that particular webcast and that's going to take you into the mechanics of placing a stop order on a futures contract. Great stuff today, guys. Thank you so much for letting me talk through this and getting into this discussion, because I think it's a really interesting discussion to have. We'll keep an eye on this. We'll keep an eye on our crude oil calendar spread here as well. I'll be back next Tuesday to talk more about this. I hope to see many of you in San Diego this weekend. On Saturday at our live event, at our Market Drive event, we're going to be at the San Diego Marriott Marquis, right by the convention center, right downtown on the waterfront. Saturday, all day long. It's going to be a free event to you. We're going to buy you breakfast. We're going to buy you lunch. We're going to have a networking reception afterwards. It's a great opportunity to come and talk to us and have a great discussion. And thank you for not letting me feel as old as I sometimes feel by knowing COBOL. We'll have more conversations about that. Have a great day, everybody. We'll see you soon. Thanks, Connie Hill. Thanks to our great reviewers, Mindy and Nikki, and our great production staff. We'll see you soon. Take care, everybody. Bye-bye.